Welcome back to the Deep Dive. Today, we're not sifting through dry market fundamentals or, trying to decipher cryptic quarterly reports.
No, not at all.
We are cracking open a hidden file on what behaves, for all intents and purposes, exactly like a secret society, an organized cartel that is controlling one of the world's most critical industrial and monetary assets.
And the sources you provided, they really frame this perfectly. They combine this deep forensic data with some pretty stark historical precedent. We are talking about the London Silver Pool.
The London Silver Pool.
And the mission today really is to move past all the speculation and determine if the actions we're seeing, these coordinated actions of major institutions in the London market, if they're following an undeniable time-stamped historical blueprint, we're looking for the truth behind the price suppression.
And behind this zero date they keep mentioning, this 2026 deadline.
The impending, mathematically fixed zero date.
Exactly. Okay, let's unpack this. Because the central thesis here, and it's supported by the data you have, it's intense. It's structural.
It is.
This entire system, this managed price that we all look at every day, is built on a paper illusion.
A facade. A sophisticated facade of physical abundance where in reality there's very little.
And history, specific history, shows us that once that physical inventory, the actual metal, runs out, that facade is absolutely guaranteed to fail.
Precisely. The question for the listener, for you, the learner, is not if this breaks. That part is, according to these sources, a given.
A question is when.
It's when. We are tracking a mathematical certainty. This is driven by the physics of inventory drainage, not by, changeable market sentiment or some fickle financial engineering.
Right.
So we have to treat the London Silver Pool like what it is. A shadowy cartel. An organized body that has successfully suppressed the price of silver for decades.
They're powerful, no doubt.
Oh, incredibly powerful, yes. But crucially, their resources are finite.
And that's the key.
That finiteness is the key to predicting their end.
I want to start with the history, because this is what takes the argument from the realm of, let's say, conspiracy theory, and puts it squarely into undeniable precedent. If you want to predict silver's future, you absolutely have to understand the collapse of the London gold pool in 1968.
It's the ghost that haunts the current silver market structure. I mean, the similarity is far beyond coincidence. It's structurally identical.
So what was it? What was the gold pool?
Well, back in the 1960s, a secret cartel, and this one was officially named the London Gold Pool, was established.
So this wasn't just a nickname. It was a real thing.
It was a real official thing. And this was not a small-time operation. We were talking about 8 major central banks.
8 of them.
8, including the U.S. Federal Reserve and the Bank of England. And they were operating in perfect coordinated secrecy for 7 years leading up to that crisis in 68.
And their objective was? It was simple, wasn't it? But it was also this massive global defense mechanism.
Exactly. They were conspiring to keep the official price of gold fixed at $35 an ounce.
$35. And why that number? Why was that so important?
Because that price peg was the linchpin of the entire post-World War II Bretton Woods system. Gold was backing the dollar and, well, the dollar was backing everything else.
So any rise in the gold price, it didn't just mean gold was worth more.
No, it signaled inflation. And worse, it signaled a crisis of confidence in the entire fiat currency system they were desperately trying to uphold.
So this was a defense of the dollar.
It was a war to defend the dollar, and it was waged aggressively with physical gold.
And their tactic was just brute force.
Brute force. It was an attempt by central planners to defy the fundamental law of supply and demand. The tactic was brutal and direct, if the price of gold even started to rise.
I say from investors wanting to cash in their paper dollars for real gold.
The pool would just unleash massive amounts of their combined strategic physical gold reserves right into the market. They would sell thousands of tons immediately just to crush any price rally.
And reading some of the historical accounts, they genuinely believed they could do this forever.
Oh, they did. Their internal messaging suggests they believed that through this coordination, they were simply more powerful, more capitalized, and more strategic than the entire free market itself.
An incredible level of hubris.
It was their tragic flaw. They acted as this perpetual price defense, selling their national treasures to manage public perception and defend that $35 peg.
But they were dealing with a physical asset.
A physical asset that was being demanded internationally, most notably by France under Charles de Gaulle.
Right. De Gaulle was famously demanding physical gold delivery for his country's dollar reserves.
He was calling their bluff. The pool could issue paper promises, they could coordinate their selling, but they couldn't physically print gold. Every single sale was an expenditure of finite resources.
So tell us about the moment the math finally caught up with them.
It happened in March of 1968. I mean, they operated for years, confident in their collective power, but the drain was just relentless.
Drip, drip, drip.
By early 68, the pool had sold so much, metal estimates suggest over 3,000 tons, that their combined physical inventory just ran dry.
They ran out of ammo.
Completely. And crucially, the market realized two things at the exact same time. First, that the fixed price was totally artificial.
And second,
that the central banks no longer possessed the physical means to defend it. The emperor had no clothes.
And the immediate result was, it was cataclysmic for the system.
It was. The fixed price mechanism just shattered. The London gold market actually had to shut down for 2 weeks.
2 weeks.
Just to reorganize itself. And when it reopened, the two-tier system was born. You had an official price and a free market price.
And the free market price?
It immediately began its explosion upward. This eventually led President Nixon to permanently close the gold window in 1971, officially ending the link between the dollar and gold.
All because the cartel ran out of ammo? Physical reality won the day.
It always does, eventually.
Okay. What's just fascinating here is that the blueprint isn't just similar. It is, as you said, structurally identical to what the sources describe in silver today.
Mm-hmm.
You have powerful, coordinated entities using massive but finite physical reserves to artificially manage a price, all to protect the larger fiat currency system.
That event, 1968, it provides the exact framework for understanding the London silver pool today. It proves, without a shadow of a doubt, that when you're dealing with a physical, monetarily significant asset, even the most massive, most coordinated central bank action has a mathematical limit when it faces persistent physical demand.
The moment the physical metal needed to back, the paper stops flowing.
The entire paper structure collapses. The pool, whether it's gold or silver, is fundamentally an inventory problem.
Not a financial problem.
Not a financial problem you can solve with liquidity. You can't print your way out of an empty vault.
So if we accept this undeniable historical precedent, the only real difference between 1968 and 2026 is the metal and the calendar.
That's right.
So now we have to look at who is running the show today.
Let's pull the curtain back. As we established, the London Silver Pool isn't an officially registered organization you can look up.
Right, there's no website.
No, but the deep forensic data, the consistent coordinated trading patterns, the massive short positions, the inventory management, it all confirms its existence as an organized cartel.
And just like its gold predecessor from the 60s, its primary goal isn't really about generating trading profits.
No, it's about systemic control. The sources are very clear on the objective. Suppress the price of silver?
Why? Why silver?
Because a low, stable silver price acts as a psychological anchor. It suggests to the general public that inflation is minimal and that the underlying fiat currencies, the dollar and the pound, are stable and strong. It's perception management.
And the operational center, the physical ground zero for this whole mechanism.
It's the LBMA, the London Bullion Market Association. This is the global nexus for the trading, the clearing, and the storage of physical silver.
But its specific structure is key to this, isn't it? For maintaining the opacity a cartel would need.
Absolutely. It's an over-the-counter market, an OTC market.
So for our listener, what does OTC mean in practical terms? Why is that lack of transparency so vital for maintaining a price suppression scheme?
Well, an OTC market means transactions are private, negotiated deals between two parties, in this case, the banks.
So not like the stock market?
Not at all. They aren't conducted on a public exchange like the COMEX, where every buy and sell order is logged in a visible order book for everyone to see.
And that opacity is everything.
It is vital, because if the public or even smaller market participants could see the true, overwhelming physical demand happening in real time, the illusion of abundance would immediately shatter.
The game would be up?
Instantly. The OTC nature allows the pool to execute these enormous, coordinated short sales and leases without leaving a transparent, publicly reportable trail of their activity. It keeps regulators and the wider market in the dark.
Okay, so we know the LBMA is the stage. Who are the key players at this shadow table?
The sources specifically name the major bullion banks who dominate the LBMA and its clearing system. You're talking about JP Morgan, HSBC, and Standard Chartered.
The usual suspects.
These are the institutions that physically manage the vast London vaults, and they are the ones responsible for orchestrating the daily fix price. The data confirms they act as a coordinated entity, the hands that manage the pressure spring to keep that price capped.
This sounds like a logistical nightmare if they had to use actual physical metal for every single suppression attempt.
It would be impossible.
So how do they maintain this? Especially when we know industrial and investment physical demand is clearly rising year after year.
And this is where we uncover the engine of deception, the core mechanism of the pool's paper scheme. It is absolutely critical for the learner to understand this.
What is it?
It's the mechanism of the unallocated accounts.
Let's dedicate some real time to this. Yeah. Explain the mechanism of unallocated ownership in detail. It sounds innocuous.
It sounds boring, and that's by design. When an investor buys silver in London, often through a major bank, they are typically sold an unallocated account.
Okay.
The term itself is vague, but the reality is harsh. You are not buying a specific, identified bar of metal sitting in a specific vault compartment with your name on it.
So what are you buying?
What you receive is merely a credit on the bank's balance sheet. It is an unsecured claim.
An IOU.
It's an IOU. The bank acknowledges they owe you the silver, but they have not physically earmarked it, set it aside, or segregated it from their own general inventory.
So if my silver isn't physically set aside, what in the world are they doing with it?
They're running a fractional reserve system, but they're applying it directly to physical metal.
Like a traditional bank taking my cash deposit and loaning it out to multiple people.
Exactly like that. In the metal market, this allows the bullion bank, a member of the pool, to sell the same specific physical bar of silver to multiple different investors.
The same bar.
The very same bar. They can sell the paper claim to 10, 20, or according to some of the more aggressive estimates in the source material, even 100 different entities, all at the same time.
So they are leveraging their tiny physical inventory massively.
Precisely. This leveraged paper issuance creates what the sources call phantom supply.
Phantom supply.
The pool is able to keep the price artificially low because they create this massive illusion of metal abundance in the market. They don't need to physically produce silver or even acquire more of it.
They just need to issue a paper credit that says they hold it for you.
That's all. It's the magician pulling endless rabbits out of a hat. But these rabbits are purely paper claims, and they all supposedly originated from a single, very finite top hat. This synthetic supply is what allows the paper price to remain completely disconnected from physical reality.
The brilliance of it, or I guess the structural peril of it, is that the unallocated account flips the investor's asset into the cartel's liquidity.
That's the perfect way to put it.
The investor thinks they own silver, but the bank views that paper claim as a liability they can use as collateral or leverage, effectively selling it outright multiple times over to influence the price through shorting. This paper mechanism is the entire fragile foundation upon which the London silver pool rests.
And this leads directly to the final existential warning that we have to deliver later on in this deep dive.
Which is?
If your silver is unallocated, it is inherently part of the pool's liquidity. You are providing the very resource the cartel uses to delay the inevitable collapse.
We have the actors, we have the opaque stage, and the fractional reserve mechanism. Right. Now let's drill down into the specific daily tactics of this hidden hand.
Right.
The leasing and shorting operations that are used to keep that beach ball pinned underwater.
These tactics are deployed whenever organic physical demand threatens to break that managed price ceiling.
So when a factory needs a huge shipment, or investors get nervous and start buying?
Exactly. When industrial demand or strong investment interest rises, the price should jump dramatically. To prevent this, the pool intervenes.
How? What's the first step?
The process starts with a major central bank or maybe a sovereign fund lending physical silver. We're talking massive 1,000-ounce bars to one of the bullion banks in the pool.
Okay, but when the central bank lends it out, doesn't that reduce their official reserve numbers?
Physically, yes, the metal leaves their vault. But here is the critical paper trickery. It's a legal sleight of hand.
What do they do?
The central bank maintains that silver on its books as an asset. It's typically listed as a loan receivable or a collateralized agreement, even though the metal is physically gone.
So on paper, it looks like they still have it.
On paper, it's still there. The bullion bank then immediately sells that borrowed silver into the open market, injecting a sudden manufactured wave of supply.
And they're not selling it because they think the price is too high.
No.
They're selling it to make the price go down. It's a proactive, market-moving, price suppression operation.
Yeah. It's aimed at crushing the upward momentum and scaring off other speculators.
Exactly. And by selling that borrowed silver, the bullion bank creates a massive paper short position.
Right. They now owe that metal back to the central bank on some future date, but they've successfully flooded the market right now, in the present moment.
So the net effect is that the market is suddenly satiated with synthetic borrowed supply.
Metal that is technically on loan and has to be paid back, it completely distorts the true organic supply from mining and recycling.
But we don't just have to guess that this is happening. The sources point to undeniable observable evidence for this.
They do.
The massive commercial net short positions seen repeatedly in the CFTC's Commitments of Traders report, the COT report.
The COT report is our window into this shadow operation. For anyone unfamiliar, the report breaks down open interest in futures markets by category. The category we watch is the commercials.
And these are supposed to be producers, users, and the bullion banks themselves.
Right. And they're typically supposed to be hedging, which means they should be either balanced or net long. However, for years, this small handful of commercial banks, the very players in the London pool, have been persistently and historically net short silver futures.
And when you say massive, we're not talking about small positions. We're talking about positions that often dwarf the positions of all other speculators combined.
We're talking about short positions that are statistically anomalous. They defy any normal risk management profile for a bank.
If a normal trader did that, they'd be ruined.
A random speculator holding a short position that large would be wiped out instantly by a minor price move. But these commercial banks hold them perpetually.
Why?
Because they are not trying to make a speculative profit, they are trying to control the price. The sources describe these massive commercial shorts as the observable footprints of the pool's operation.
So this is the proof.
They are the undeniable evidence that this coordinated entity is actively and aggressively managing the price structure.
So we're looking at that ghostly hand described in the sources, the one constantly smacking the price down. But the hand is actually visible through the public COT data.
The visibility is key, but this leads us directly to the urgency angle.
The clock is ticking.
The clock is ticking. This tactic leasing and shorting is resource intensive. It only works if you have metal to lease.
Right.
So if the pool is exerting maximum effort using historically extreme short positions just to defend the current price levels, what does that tell you?
It tells you they're running dangerously low on physical ammunition.
The pressure is mounting. It suggests that massive, ghostly hand pressing down on the price spring is beginning to shake.
That's the crucial weakness, isn't it?
It's their Achilles heel. They are powerful, yes, but their resources are finite. They can print paper shorts endlessly, but every time they suppress the price using physical leased silver, they are draining the very physical source they need for the next crisis.
The pressure they're exerting is now visible not just in the COT report,
but in the instability of the market structure itself. Cracks are appearing because the physical metal needed to back their paper positions is dwindling rapidly.
They're exhausting their strategic ammunition.
In a futile effort to delay the inevitable. Which brings us to the mathematical hard stop. The deadline.
Let's get mathematical. The sources point to 2026 as the zero date. And to be clear, this isn't arbitrary speculation or some kind of sentiment-driven fear.
Not at all. It is based purely on the burn rate calculation of the specific physical inventory available to the pool in London.
The cold, hard core of the analysis.
Exactly. We are tracking the physical reality on the ground, the actual weight of silver bars in the LBMA vaults. And since late 2021, the reported LBMA inventories have been falling. Steadily and significantly.
This isn't a guess. This is inventory drainage analysis.
And the data is alarming. The analysis also indicates precisely where that metal is going. It's not just moving from one vault to another inside London to be leased again.
Where's it going?
Massive amounts of silver are flowing out of London and heading east, specifically to key markets in India and China.
Why there?
Because these nations are prioritizing the acquisition of physical assets. They understand the leverage inherent in the Western paper system, and they want the real thing. This persistent, accelerating outflow is what sets the burn rate.
Now, we have to clarify a common point of confusion here. The LBMA often quotes a high total inventory figure.
Yeah, they'll say something like, we have 800 million ounces.
But that figure is highly misleading in the context of manipulation. Why is that total number essentially meaningless for the pool's operation?
Because most of that metal is already legally owned and strictly unavailable for sale or leasing.
It's spoken for.
It's spoken for. It is held by specific large entities that have paid for allocated storage. Think major physical-backed ETFs like SLV or private family offices, central banks, and sovereign funds that have specifically earmarked those bars.
So it's ring-fenced, it's locked up, it's not part of the flexible supply available to the pool for their games.
Exactly. So we have to distinguish between the total inventory and what the sources call the effective float.
The effective float.
Absolutely. The free float or effective float is the critical non-earmark amount of silver actually available to the cartel to lease out, to short the market, and to use as their price management ammunition.
That is the true diminishing resource we need to track.
That's the fuel in the tank.
Yeah.
And the analysts behind these source materials have calculated that at the current persistent drain rate,
Which they estimate is.
conservatively, between 100 to 150 million ounces per year flowing out of London and into that industrial and eastern pipeline.
At that rate,
The free float hits the mathematical limit of 0 sometime in 2026.
that synthesis changes the conversation entirely. It's not a price prediction anymore. It is a countdown timer. If the burn rate is consistent and the float is finite, the time is fixed.
It's a deadline dictated by physics, not finance.
And when that float hits 0, what happens?
Two things happen simultaneously. First, the ability to lease new silver stops immediately. Second, the ability to suppress the price through synthetic paper supply stops immediately. The pool runs completely and undeniably dry.
This is the market reset. This is 1968 all over again, but with silver.
The physical exhaustion moment.
So if that free float collapses, what happens to the massive number of unallocated paper claims that are still outstanding?
The sources are very clear on this. The paper claims outstanding likely far exceed the remaining physical float, possibly by an order of magnitude.
So the collapse of the float exposes the fractional reserve scheme.
It's a bank run on metal. You have 1,000 claims on 10 ounces of silver. Who gets the 10 ounces?
This is why that visual of the fuel gauge is so potent. The gauge is labeled LBMA float. It's buried deep in the E for empty zone.
And the sticky note on the dashboard says deadline 2026. You cannot extend and pretend when the vault is physically empty and the claim holders start demanding actual delivery. The leverage instantly becomes infinite pressure.
The power of that date is that it changes the game from being about market trading to a structural, time-sensitive failure of the entire system.
And now let's identify the unstoppable force that ensures this strain continues. The force that makes the 2026 date a near certainty.
The catalyst.
The catalyst that is rapidly consuming the inventory is not speculative buying by investors, although that certainly contributes.
No. What is it then?
It is primarily industry. And this is a crucial distinction between the crisis of 1968 and the impending crisis of 2026.
Okay, explain that. In 1968, the gold pool broke, mainly because investors were demanding physical gold to protect their wealth. Monetary demand.
Exactly. In 2026, the silver pool is being drained by operational necessity, by factories, by refineries, by high-tech manufacturers. This is the coming squeeze.
And the sources identify two key, massive industrial drivers for this.
They do.
Yeah.
The booming solar energy industry and, less discussed but equally critical, the military and defense sector.
And these two sectors are what analysts call inelastic buyers. We need to explain why that term is the single greatest threat to the London silver pool.
Inelastic demand. It means their purchasing volume is fixed regardless of the London fixed price. They need the metal to fulfill production mandates, not to speculate on the price.
It's a non-negotiable input for it.
Absolutely. A solar panel manufacturer cannot substitute silver for copper, for example, and achieve the required photovoltaic efficiency. It doesn't work.
And the military.
Military contractors cannot print a silver bar for the crucial component inside a guidance system or a Tomahawk missile. They need the metal, period.
So if the price of silver goes from, say, $25 to $125 overnight.
The factory still places the order.
Yeah.
Because the price of the silver in that solar panel or that missile is negligible compared to the total contract value or the strategic necessity of the final product.
They don't care about the price.
They don't care if it's 25 or 250. They have manufacturing deadlines, they have government contracts, and they have existential product needs that require the physical delivery of millions of ounces of high-purity metal every single month.
They are price takers, not price makers. And they're completely immune to the bullion bank's suppression tactics.
That's the key. And this creates a fundamental nuclear conflict between the pool's paper schemes and physical reality.
Collusion course.
The paper scheme requires the price to stay low to maintain the illusion of currency stability. But physical reality requires millions of ounces of metal to be taken off the table, melted down, and put into circuits and panels every single month.
That constant, relentless physical demand is the existential enemy of the paper pool.
Every single month, industrial entities take delivery of thousands of bars. And unlike a financial investor who might eventually sell it back,
The factory consumes it.
it's gone, forever from the market float. The pool can short against a financial speculator hoping to scare them into selling, but they cannot short against a factory that needs the metal for its essential product.
The sources paint a powerful visual of this conflict. The pool is trying to hold a beach ball underwater with maximum force,
Right.
using up all their energy and resource capital, but the solar industry is simultaneously pumping air into the beach ball, trying to fill its own mandates. The force needed to hold it down is becoming mathematically impossible to sustain.
We are witnessing an arm wrestling match between the robotic, unstoppable arm of industrial demand made of steel and fueled by contracts, and the weakening, increasingly desperate arm of the LBMA banks.
And the industrial arm never gets tired.
It never gets tired. Industrial reality dictates that metal must be delivered, and those deliveries are consuming the very liquidity the pool needs to maintain its paper charade. The moment the pool can no longer satisfy those inelastic buyers with leased, borrowed, or unallocated metal, the entire structure fails.
What happens then?
Industrial buyers will simply bypass the official LBMA price entirely. They'll pay whatever parallel, non-fixed price is necessary to keep their production lines running.
We have meticulously traced this specific inventory problem to a fixed date. Now, we have to connect this specific failure back to the global financial system. What happens when the London price fix breaks in 2026? This is far more than just a massive spike in silver prices. It's a systemic shockwave.
It is. Silver, in this context, is the fuse that detonates the broader system.
Silver is the canary in the coal mine.
Or perhaps the gateway drug to monetary chaos, because its market is the most shallow and its inventory is the most easily quantified. Once the physical exhaustion is undeniable in the silver market, the sequence of the domino effect begins.
Let's track that sequence. Domino number 1.
The first domino is the silver market breaking. This happens when the free float hits zero, the suppression stops, and true price discovery is unleashed.
And when investors and institutions see the price explode because there's simply no physical supply left in the West, what is the immediate logical conclusion they draw about the financial institutions involved?
Panic and distrust. If the same institutions, the same bullion banks ran out of silver because they leveraged it too heavily.
The next logical step is to look at their sister market.
Gold.
Gold.
Exactly. The second domino falls. Trust in the gold market evaporates. People realize that the gold market, which is also run primarily through the same LBMA OTC structure and the same unallocated account schemes, is likely leveraged far beyond the physical metal available.
So investors start pulling allocated gold out of London.
Accelerating that drain, and this fear of leverage then cascades into the market that's presumed to be the safest of all.
Sovereign bonds, the bedrock of Western finance.
The third domino is systemic. If investors lose faith in the metal markets, the only truly unprintable assets, they start questioning the solvency and integrity of the central banks and sovereign nations that issue the vast amounts of debt.
So a failure in a small commodity market
Exposes a critical underlying reality. The entire Western financial system is predicated on massive leverage. The sources suggest this leverage could be as high as 100 to 1 in some areas of the derivative and bond markets.
And silver's collapse is the proof.
It provides irrefutable proof, on a micro level, that the physical assets backing the paper promises simply aren't there on a macro level either. It shatters the fundamental assumption of solvency.
Once that happens, trust in the fiat currency itself, the final domino, begins to erode rapidly. So what are the immediate real-world consequences for the listener, for you, the learner, when this chaos is unleashed in 2026?
The primary immediate consequence is extreme, sustained volatility. The market will shift overnight from a managed, predictable environment to a chaotic, free market driven by panic and necessity.
And second,
And this is crucial for anyone involved in trading. You will likely see widespread trading halts.
explain the trading halt mechanic in this context. Why would that happen?
When price discovery completely breaks, meaning the official exchanges can no longer reliably quote a price that is remotely close to what people are willing to pay for physical delivery, they invoke safety measures. They halt trading.
For how long?
Possibly for days or weeks. This stops the bleeding for the short sellers, for the pool, but it locks everyone else out. Industry can't secure supply, and investors can't liquidate positions.
So if official trading halts, that means the managed spot price that we see on our screens may just disappear.
Precisely. It will be replaced by a massive, immediate, and sustained premium for physical metal delivery. This will be a black market or parallel price, driven by industrial necessity and the desperate demand for actual delivery.
So the screen price might say $30.
But the price you have to pay a dealer for a physical bar might be $150. That massive widening spread is the proof that the paper market is defunct.
That entire segment paints a picture of a controlled collapse leading to absolute systemic chaos. And it's all triggered by one simple arithmetic failure: the exhaustion of the physical silver float.
We are in the final innings of this rig market. Let's summarize the current signs of desperation that prove the pool is breaking, and then outline the smart money playbook based only on what's in this source material.
Okay.
What are the undeniable signs of the imminent collapse that we can see right now?
We see clear signs of desperation, not stability. First, the Shanghai premium.
Explain that.
The East, which demands and receives physical delivery, is consistently paying demonstrably more for silver than the paper price quoted in London or New York. That spread is the fundamental stress gauge. The East is signaling that the Western price is fictional.
Okay, what's second?
Second, the undeniable inventory drain. The West is running out of physical metal, and the LBMA's own numbers confirm the consistent outflow. It's not a secret.
Third, the geopolitical split.
BRICS nations and nations outside the Western fiat system are aggressively hoarding physical assets. They are positioning themselves for a world where paper claims and leverage systems collapse. They are betting on the failure of this structure.
And fourth, something called margin hikes. Margin hikes are the pool's last-ditch defense mechanism. When the price attempts to break out, rather than allowing true price discovery, the exchanges, often acting on behalf of the commercial short interests, will dramatically hike the collateral required to hold a paper position.
Forcing the little guy out.
It forces smaller speculators to sell their positions, which relieves the pressure on the commercial short sellers. It's a sign of immense stress, not market health. It's a desperate attempt to reset the chessboard right before checkmate.
These signs all point to one conclusion: the pool king is cornered. The 2026 deadline is the mathematical limit. You cannot divide by zero physical metal.
Correct. When the vault hits zero effective float, the ability to maintain the price fix ceases, and the paper price in fiat terms logically goes toward true physical scarcity.
Which analysts suggest could be?
It could easily be $100 or $200 per ounce, or even higher in that initial period of chaos. Checkmate is one move away, and the velocity of that final move is dictated by the industrial burn rate.
So, given the historical precedent of 1968 and the mathematical reality of 2026, what is the smart money playbook for the listener? Based on the non-negotiable warnings in these sources, we have 4 key takeaways.
The first rule is driven by that countdown timer. Beat the clock.
Don't wait.
The sources are clear. Do not wait until 2026 to act. By the time the final inventory figures are published showing zero float, the metal will either be gone from the available market entirely, or the price reset will have already begun,
Locking new buyers out at unaffordable levels.
The second point is perhaps the most crucial warning we can offer today. It addresses the inherent danger of that fractional reserve system. This is an urgent warning. Get out of the pool.
What does that mean, practically?
This is a stern existential warning. If you hold unallocated silver, meaning paper credits in London, or through banks tied to the LBMA, or if your ETFs rely on silver stored in that system, you are structurally part of the pool's liquidity.
You are the ammunition.
You are the ammunition. The cartel, in a systemic crisis, will use your metal to cover their own more critical exposures. The sources explicitly warn that unallocated accounts are the first casualties.
Why?
Because the bank needs that metal to satisfy its more powerful counterparties or regulatory demands. Your paper claim may become worthless as they seize or severely delay delivery of the metal you thought you owned.
That's a terrifying implication.
Yeah.
If you own paper claims in a bank that is part of the cartel, you are effectively the collateral they will burn to save themselves.
The only safety is physical segregation or possession outside their system.
Okay, third point.
The third piece of actionable knowledge is to watch the spread. The critical difference between the managed paper spot price and the true physical price. The premium you pay for a real deliverable bar in your hand is your stress gauge.
And as that spread
This
widens,
means the pool is under greater duress, the paper fiction is dissolving, and the end is drawing nearer.
and finally, the fourth point, prepare for the reset.
When the pool fails, silver re-rates dramatically. The artificial ceiling will be removed, and the price will establish a new, permanent floor that reflects true physical scarcity, industrial necessity, and monetary value.
Potentially $100, $200, as some analysts suggest.
The goal for you, the learner, is to be holding the asset before that reset occurs, not holding the currency that is collapsing under the weight of the leverage silver exposes.
This entire deep dive, tracing the mechanism from the undeniable 1968 collapse to the 2026 mathematical deadline, it reveals a sophisticated, powerful, but ultimately doomed operation. The secret is out, the evidence of suppression is clear, and the physical limit is fixed. This has been an extraordinary journey, taking us from a historical footnote involving 8 central banks in the 1960s to the current 2026 countdown, driven by the unstoppable forces of solar energy and defense mandates.
It's quite a story.
We have established that the London silver pool is real, that it operates as a coordinated cartel, but is ultimately finite and beholden to the law of physics. They are running out of ammo, and time is running out for their paper illusion.
And that fixed date leads us to a necessary, final, provocative thought.
Leave us with this.
If a secret cartel could successfully manipulate one of the world's most critical industrial and monetary metals for decades, using opaque paper credits and massive fractional reserve schemes, and if that imminent failure is set to expose the system's catastrophic underlying leverage, what other major markets, gold, sovereign bonds, or even currency futures, might also be leveraged 100-to-1 behind a similar veil of opacity?
What other clock is ticking?
What other clock is ticking in the background right now that we just haven't located or calculated the inventory burn rate for yet?
An essential question to ponder as we close the file on this deep dive into the 2026 deadline. Thank you for providing this source material that allowed us to uncover this mechanism.
My pleasure.
As always, the future belongs to the owners.